about what you think about. Say it again, and that's a fact. Think about what you think about.
Welcome to Itscontrarian channel. Today is 28th April 2023. These are the topics that we're going to discuss today. Bulls versus bears, the charts of SPX, QQQ, VIX and 10-year yield, and the trade of the week month tracker. We'll start with bulls versus bears argument. The first one is the crash of the regional banks. So the bulls argument is that since March 3rd, 3 of the top 30 banks have collapsed. The 14th largest bank, First Republic, 16th largest bank, Silicon Valley Bank, and 29th largest bank, Signature Bank. Due to this reason, the Fed needs to cut or pass the interest rate in order to avoid the further damage. While the bears argue that the big tech earnings are great, look at Microsoft, Meta, Amazon, and Google. They've all beaten estimates. Same is the case for some of the big banks, JP Morgan, Bank of America. And no negative earnings from any major firms, and that the unemployment rate is still low. If Fed passes or cuts rates, then it means that they're accepting that it is indeed a recession now. Now let's take a look at the next argument. Inflation has lowered. So, the bulls argue that the inflation has come down from 7% in June 2022 to 4.2% in March 2023. There is no urgency for the Fed to further increase the rates. While the bears argue that the core PCE inflation hardly has changed and sticky at 4.6% in March 2023. For the last 2 years, the core PCE is ranging from 4.5% to 6% and nothing major has changed. Fed has to continue raising rates to get to 2% inflation target. The next argument is the bonds versus equity. Bulls argue equity market is calm, while bears argue bonds market is pricing a recession and equity will catch up soon. Take a look at this.
Seen ever or for a long time. I'll give you 2 examples. 3 months spread relative to 1 month at levels we haven't seen, astronomical levels. The 5-year CDS, credit default swap, is back over 50 basis points. We haven't seen that in the last 10 years. So the equity market actually is calming, is comforting. It is the bond market that's sending all these conflicting signals. I myself can't make what to think of what's going on in these parts of the bond market that we're not used to look at.
And that makes you want to do what with investments at this point?
It just reflects, I think the bond market recognizes and has embraced that there's a lot of uncertainty and that you've got to factor that in. The equity market is talking less uncertainty, and I just worry that you don't want to commit fully to this equity market until you figure out the things that we don't know.
Mohammad Al-Brian, Chief Economist Advisor for Alliance, thinks that the bonds market is sending conflicting signals and recognizing the uncertainty. The next topic is employee layoff. Recently, big firms such as Amazon, Google, and Meta announced the employee layoffs. Bulls argue that the employee layoff has made the company efficient and operating margins are better. However, the bears argue that the layoff meant that there is no growth and these firms are already considering a recession. Higher unemployment rate is the last stage in the recession. Take a look at this chart of S&P 500 versus PMI. As the PMI drops down below 50, the S&P 500 drops significantly in the charts. So it's just a matter of time for S&P 500 to drop since PMI is below 50. We'll take a look at the other chart, which is the PMI versus unemployment rate chart. This shows that if PMI drops below 37, unemployment rate shoots up exponentially. We have seen these in 2008 and 2020. So it's just a matter of time before the unemployment rate shoots up. The next one is the low put call ratio and VIX value. Bulls argue that in a calm market, low put call ratio and low VIX is normal and nothing to be concerned about. While bears argue that this is a sign that investors are laid back. The data that we have got so far does not point to a clear and comforting market, especially with inflation being sticky and VIX can move significantly in no time. The next one is VIX versus VVIX. Bears argue that the VVIX is a leading indicator and that it is diverging from VIX, and VIX will soon catch up like in the past as shown in the charts. VVIX measures the volatility of VIX. The next one is the M2 money supply. M2 measures the nation's overall stash of cash or cash-like liquid assets. This includes cash, coins, bills, bank deposits, money market funds, and when the M2 goes down, the ability to spend is limited. M2 has been contracting as shown in the charts, and it has been a great indicator for the coming recessions. The next one is the Fed Net Liquidity. The chart shows the fair value of SPX is between 3,600 and 3,800, and SPX will soon drop to match the fair value. The next one is a lucrative alternative to stocks. Bears argue that there is a fairly safe 4 to 5% interest that one can get by investing in bonds or term deposits, and hence there is no urgency to invest in stocks, and hence most are moving out of the equity market due to the risk and the uncertain returns ahead. This will cause a further downside to the stock prices and invariably a recession. The next one is the yield curve inversion. Short-term bonds have a higher interest rate as compared to the long-term bonds. This has been a reliable recession indicator for a long time, and we are currently in one of the deepest yield curve inversions, and the recession looks more certain. Take a look at this.
You know, I smiled when I saw the New York Times, of all newspapers, the New York Times talking about the bond market and calling it bonkers.
Yeah.
And it has been bonkers. Look at the 2 years. Look what is it's moving again today.
You've said this Fed is too data dependent. Is that what you're saying right now?
Excessively data dependent. It has to have a longer term view. It has to be anchored by some strategic view of the economy. Of course, it's a gamble, but without that, even cash management becomes really hard. Just, again, look at the volatility in the 2 year.
Well, the IMF's taken a view, haven't they?
They have.
They've said we're going back to the pre-pandemic world of low interest rates. Do you sense that's the Fed's view?
I don't know what the Fed's view is, and that's one of the problems. I don't know what the Fed's longer-term view is. It's interesting. I mean, Olivier Blanchard has taken the same view. You know, I am not there. I think we live in an economy that's supply pressured for the next few years. So I do not see inflation going down quickly. I do not see interest rate going down quickly. But those who simply extrapolate the past argue that this will happen.
With this, we are ending the bulls versus bears argument. Now let's get into the charts. First, let's take a look at the volatility index of VIX. It is currently at 15.78, the lowest value in the last 6 months. MACD is sloping downwards, but the RSI is not at the lowest point. VIX may go down in the short term, but we have Apple's earnings next week and Fed's future rate decision outlook that can shift the market breadth. Now let's take a look at SPX. It is at 4169.48, the highest point in the last month. However, MACD and RSI are not at the highest point, and hence there is a greater chance that this might go down on Monday. QQQ is similar, highest point in the last month, but MACD and RSI are not at the highest point. Next, let's look at the 10-year yield. It is at 3.41 and not at the lowest point in the last month. Bullish ABC pattern is possible, that is, it went from 3.5 to 3.41 and then can go up to 3.6. RSI is not at the lowest point and hence the bullish outlook. So at this point, VIX, SPX and QQQ are working together in correlation, but the 10-year yield is not. We have to wait and see how this unfolds in the next week with Apple's earnings and Fed's future rate outlook. Now let's take a look at the trade of the week and month tracker. In this channel, I suggested to initiate a trade with any ETF related to VIX on 17th April 2023. VIX and UVXY made a 10% gain. UVIX made about 13% gain as on 24th April 2023. However, they are at a loss of 7% and 9% as of Friday. However, the trade is still good and we are good to regain our profits and much more in a short time. As we can see in the video, The downside for VIX is far less as compared to the upside. Next week's Apple earnings and Fed rates outlook will move the VIX, and let's wait and capitalize on the same. With this, we have come to the end of this video, and if you like it, please like, comment and subscribe to this channel. I will see you again in a few days with my next video.